Hello and welcome to Market Today. I'm Siddharth Zarabi, and you're watching our Diwali special series with Market Masters. And on the show today with us, Ajay Srivastava, the CEO of Dimensions Consulting. Uh, Morning, Ajay. Welcome. Happy Diwali to you and everyone in your family
Same to
and
all your
colleagues.
viewers.
Thank you for that. Ajay, as we try and look into and try and create and spread some festive cheer, all of us have a responsibility towards that for the broader economy. I want to begin by asking you that the fact seems to be that Diwali has never been so bad for Nifty bulls for almost 10 years now. Is it time to buy the fear?
You know, I keep looking at, it's Diwali is a good landmark to look at because the Samvat starts there. But I would say that the important element is what our forefathers, grandfathers, and mothers taught us that Diwali is the day you buy gold and you buy silver, whatever you can afford. And I think the same theme continues today that people who had gone totally into equities would have realized that there is a need to diversify out into gold and silver, which are the standout metals for this year, particularly gold, more important from a longer term perspective. And I think that realignment, readjustment has to happen to portfolios, will happen to portfolios at this point of time because everybody thought gold is a fuddy duddy item totally. Why buy it? Only your grandmother bought it. But now you realize suddenly gold is good. And I think fundamentally, this is going to be one year where there'll be serious alignment of portfolios and a lot of money which would have gone to equities or has gone to equities will now go towards maybe physical gold, maybe digital gold. But definitely speaking, I think next year you will see more share coming from gold as has been this year than equities perhaps.
Okay, so gold, silver, what Ajay said, age-old Indian wisdom and the desire to, buy gold, and that's why from times immemorial, India has been a sum for gold from all over the world. But Ajay, uh, there are two factors that are being attributed to this current worst pre-Diwali phase that we have seen in our markets for quite some time now. One is earnings growth and the other is the FII outflow, which seems to have been triggered by uh, China, almost 1 lakh crore plus over 18 sessions. Give us your thoughts on these two factors, and is there light at the end of the tunnel when it comes to both these factors?
You know, one. Let's put context. The whole of FI sales, which went out, was almost 1 lakh crore or approximately that. But if you look at one IPO alone, okay, which was a pure OFS, which is Hyundai, 28,000 crore was put into the company. So Hyundai company took it out of the country. So just so what's happening? The excesses of the IPO market are now coming to bear. Why would you want to put 28,000 crore in an OFS in an auto company with a slowdown happening, and all the money goes out of the country? So yes, FIs will sell, and they continue to sell because our valuations were significantly in the higher side, and there's no doubt in the mind that we were reaching a point where it was more hope than in terms of valuation. And that's why all of us have been talking about caution that a lot of stocks are overvalued. So, so contextually speaking, FI has done the correct thing, is shopping from destinations where they can get money. Yes, the China initiatives took everybody by surprise. Nobody expecting Chinese government to step in. It did step in, and that's what caused the surprise in the global market. Suddenly, people said, "My God, China is serious about economic revival," which they were not. If you remember the incident of Jack Ma and everybody, where the IPOs was scuttled, the education tech sector was demolished in China completely, consumer space was held captive by the government. Suddenly, there was a change of heart in Chinese government, which caught the equity market by surprise, and therefore the rush to get into China. It will impact us, definitely impact us, but I think more what will impact us, and I think that's more important. As I said in my starting sentence, is the people need to rebalance their portfolios. Over optimism on equity side will get tempered now. People look at debt, people look at gold, people look at assets of other kind, and real estate, unfortunately, will not be any asset anymore. It's so expensive, it's ludicrous, absolutely real estate. So where does the money go? The money will go, a lot of money will go to debt. in my view, and metals. And FI flows will stem. I think the correction is a logical place to happen. The moment you correct significantly what's already underway, sooner or later you become a value buy in the market. And we are hoping that this festive season should do a little better than this last quarter. And therefore, there should be some important of financial numbers should improve in the next quarter. So it's not all gloom and doom. These cycles will happen. These cycles rebalance. The good part, the people who are waiting with money, people who are earning money, can now invest comfortably in the market instead of
Okay.
investing on highs. So market gives you a chance. This is a good chance to be in. Whether you want to buy today or wait for a week is your call. But this is a beautiful part of the market. It always gives you a chance to get in.
Okay, since you said people waiting on the side with money, and I have two, three follow-ups to your present answer. The first, if someone had 10,000 rupees or 1 lakh rupees of fresh capital to deploy, and you spoke about rebalancing your portfolio, and I'm obviously talking about the wide retail market participants in India, that huge base, what would be the mix that you would advise them from that capital, let's say 1 lakh rupees available to deploy anytime starting now?
See, it depends again where you are, but I can just suggest to everybody that listen, some things, stories in India are panning out quite well. One is the hotel stories are panning out quite well. The aviation story only, unfortunately, one or two listed stocks. Only one is, the relevant stock. So that's not too many options. Between the aviation hotel story, I think you have a wonderful story coming up. And the third is the power story. These three stories have got a great amount of traction inside the country as well, and we don't need to worry about it. And the last one is pharma and hospitals. I think, again, you need to be patient with them. India's aging population, we need more healthcare services, government allocation is falling, and you're seeing gradually the healthcare industry is giving superior returns, whether it is the pharma companies or the hospital companies. I think pharma and hospitals have to be the most integral part of your portfolio because that is a necessity. It's not a discretionary spend. Buying a bike, buying a car is discretionary, flying is discretionary. But if you have got a heart attack, you got to go to the hospital. It's not discretionary. So I would say number one thing anyone should buy in this country is pharma and hospitals. Then you follow down to consumer themes like hotels, which are expanding rapidly, maybe aviation. Then you go down ladder called power. And I think this is where you will try to build a portfolio at this point of time.
Ajay, earlier this year, you had spoken about adding capital market related companies and metal and aviation. You spoke about aviation, but what about the other two baskets?
See, capital market, I think we are a lot of it are over invested. That's why I didn't name it, which is a capital market means stock exchange, AMCs, depositories, and companies which manage mutual fund. Really, this is the we're talking about it, and maybe one or two NBFCs which deal in the market brokerages which have got equity interest in the market. I think this is your sum total of capital market. The problem is today is it's at the peak at this point of time, and the growth numbers being baked into those prices are huge today. So they were good 6 months back. They are still relevant for the next 3 year perspective. But I think in the next 1 year we will see tempered down. And as I said, tempered down because these corrections bring long lasting change in behavior of consumers at least in the next 6 to 9 months. And when caution becomes the name of the game, when you start to get worried with the losses and you need to recoup it, the exuberance goes down for the capital market. Exuberance means trading goes down. Trading goes down, revenue goes down. The mutual funds will slow down a little bit because more will go into debt than equity. That's why I kept capital market today out of the time being because given what's happening in the market, given the valuation of the shares, and the fact that we expect NSE to come and become listed stock eventually, maybe in a year's time, I think that it's pretty crowded market and well valued market. So perhaps your returns may be muted if you go in now. If you wait 6 to 9 months, I think you will have a fantastic run on these stocks.
So, to summarize, if a viewer was interested in asking you how you have rebalanced your portfolio in the current phase, how would you summarize it? What changes have you made? I imagine some of the points that you made are already baked in.
Like we have almost zero FMCG stocks in our portfolio for almost a year and a half. Zero FMCG. You'll find it surprising. Zero banking. So two of the industry's large component we have zero. We have reduced the weightage to capital goods stock in this in our portfolio at this point of time. increase the weightage dramatically for healthcare, hospitals, remain our weightage for aviation and hotels. But the two things, and the capital market remains where it is, but two standouts are pure elimination of FMCG last 1.5 years and banking stocks. I think these are two big changes we did about a year back, and they've done okay. I think the calls have been okay.
We have heard managements of HUL and Nestle talk about the consumption slowdown. How long do you think this will continue? And will there be, in your view, an opportunity anytime in the near future to relook the entire consumption play?
The problem with the MNCs is they have management, which is just somnolent, just sleeping through their retirement plans. That's what the point is. These are not hungry management. They are being challenged every day by new startup. You see a new startup like a Honasa come up and says, "I'll give you chemical-free products." What has HLL done in response? Zero. We've got, the Bhikajis and the other who's coming up in the Namkeen market and so on. What has Nestle done about it to compete in those markets? We had the sugar controversy with Cerelac, for instance, right? The question is, these are retired management. I call them retired management. There's no hunger in the management. Forget the company. It's people who run it. You saw what happened in United Spirituals a long time, and it continues to just amble along because these MNCs are hiring people who are employees, not entrepreneurs. And they face a challenge. The challenge is the startups are coming into boot. You saw how the startup has come into the economics, the distribution sector, in the consumer sector, new companies are coming and challenging them. So not only the fact they're facing a depleting market share, they're also seeing new competition coming up. Now, will HUL cannibalize the existing product which have got chemicals in it to launch a chemical-free product? No, they're not doing it globally. They can't do it in India. So the view on these companies is on the management side, on the product side, these are retired companies and they will be challenged by the startup and they will acquire market share. And you've seen already what's happening. So many new companies have come up and produced new products in the market. So huge competition, poor management who run an employee-based model of compensation for themselves and they just retire out easily. And therefore, why would you want to invest in an environment where we got 200 IPOs this year of various companies and a growth stage of 30-40%? These companies will at best grow 5, 7, 10%. We got enough opportunities to invest in companies growing 20, 30, 40%. So just on relative basis, they're not found good. I think they are really on the last rungs. That generation with light MNC stocks as the bellwether is over. I think that era is over. We need to recognize that. We will not be paying fees of 50, 60, 70s to a Nestle and Hindustan Lever. And if you are paying, I think you're asking for trouble.
Connecting your earlier answer on IPO and the fact that the Hyundai OFS, for example, and the 200 in the pipeline, the obvious question that our viewers might have, Ajay, for you, listening to you, would be how do I therefore select the right IPO given the overall macro context, and how do I avoid falling in a trap and look beyond just listing gains?
Well, I think Hyundai has proven that the retail is smart in India. I think they know what they're doing by and large. Like all investors, we all make mistakes. Retail make mistakes. A lot of times, professional companies exemplify that retail is stupid. Retail is not stupid. They're smart people. People who are stupid who put money in a Hyundai IPO for OFS. I think those are the stupid bunch of people. If you ask me personally, so I would still believe that a lot of IPOs coming up have value, but almost half of them are a problem on valuations. And I think that's the key. It's not about just IPO. What is the value you get? If you're buying into an IPO at 40, 50 Ps, then your gains cannot be very significant in a market which is now corrected and is a little more serious about valuation. There was a time when momentum carries everybody. All ships go up when there is a flooding season. So that's fine. But today, you will be careful. Retail market has been careful and they've been very smart in avoiding issues like Hyundai, which just went to the market. So I'm not worried about, the key issue is merchant bankers. They need to be responsible to ensure the fact that valuations have become a little more reasonable as they come to the market. Gouging the market is not a good idea for momentum. Giving value is good. And I think a recent news today that one of the large issues coming up has revised the valuation in the last week or so would be a good news. So maybe, we'll see good valuations coming into the market after this slowdown.
Absolutely. So if your existing portfolio has taken a bit of a beating, But if you are a consistent investor, what Ajay seems to be saying to the average retail investor is look for value picks because IPO issuers themselves will now reset their expectations lower. You also spoke about hungry for growth. I'm wondering, Ajay, if you would like to talk about some hungry for growth stocks that fit into your categorization when you were talking about the MNCs just a little while ago.
See, as I said, hotels. I think we have a listed stock where the CEO is hungry for growth, both in terms of average revenue per room and in terms of expansion. Capacity is going to expand by about 50-60% in an industry like hotel, which is not easy. So if the hotel industry, two or three players are talking of 40-50% expansion in capacity, that's called hungry for growth. Then you have the new tech companies which are coming out. Now, they're not talking of 10-20%, they're talking of 30-40-50% growth in their models. So, if you look at these two sectors, the third large sector, which is strange, capital intensive, but the sector which is most hungry for growth is power sector. If you look at the top three power companies, they are talking of 50% expansion in capacity in 3 to 5 years. It's humongous from context of the money required and what it will do to the financials of the company. So look at hospitals. They are talking of expansion. Pharma companies expansion. Hotels companies are talking expansion. Airline are talking expansion. New tech companies are talking expansion. Hospital talking expansion. And these are core needs of India. And if you notice it, all are domestically focused. So we don't need to go out and export and find a market. The market is exists in India. We have got it taped up. So look at the six sectors, fantastic growth rate. And then you look at others where they are just dawdling along and so on. That's one. Number two, some of the sectors come with growth but competition, like cement. So you avoid it. These some of the sectors like aviation, hotels come with growth with not so much of competition. And that's what you like about the sector. Power, you just need power at the end of the day, so you're not worried about competition.
Okay.
So I think more than just the growth, look at also who is competing in the space.
Ajay, railways, defense, capital goods, the overall PSU story that dominates many of these sectors. There's been an almost 40% correction, give or take a few. Does it make sense, therefore, to look at them once again, given the valuations and the fact that the broader focus remains as far as government spending is concerned? Although I must also tell you and our viewers that uh, just a little while ago, Business Today has reported that the finance ministry feels that the allocation that was made in the budget earlier may not get spent entirely because the first 3-4 months could not due to the election impact, and then there's a bit of a sort of slowdown in some ways on spending that has come up. So while that may be a small factor, Ajay, the broader question, time to look at the PSU story again due to lower valuation?
PSUs have flattered to deceive is not the first time. It's been a cycle of this thing. And that's why, you need to consider PSU from a standpoint of a trading profile more than just an investment profile. Because still there's a government change in government policy on PSUs. Look at oil marketing companies. They were supposed to get quote unquote freedom to quote prices in the market. It didn't happen, really speaking. So so when you're investing in PSU companies, you must understand the fact that these are heavily government controlled, bureaucratic controlled companies who will dictate government's agenda more than investors' agenda. And therefore, one has to temper down expectation. Yes, there was a cycle of 1.5, 2 years where suddenly everybody discovered PSU stock. But look at longer term, 10-year time frame of PSU stocks. They have underperformed the market by a fair degree. So, don't take 2 years as an example. Be cautious that PSUs dictated by government, even the defense companies. The margins depend upon, it's Mazagon selling to defense ministry. Now, how do you price a ship which is between defense ministry's allocation and Mazagon to get profit? Now, if you're a Mazagon shareholder and ministry says, we're not going to give you enough profits to Mazagon beyond 7%, you got a bad investment on hold. So you need to temper down PSU defense stocks because they will be government controlled. You made good money, you walk out with good money. If you're not walked out with good money, perhaps you still can walk out with good money. Come back and reinvest. Sure, absolutely. Everything which goes down will come up for review in a matter of 3 months' time or 2 months' time. But the key again is even if you reinvest back, you reinvest for two things, PSU stock. dividend or capital gain. If you like dividend, I think some of those stocks are pretty good, like the RSCs, the PFCFCs world, they give pretty good dividend yields. So when the value comes down, they're good. But for capital gains, you need to exit these stocks in time. Just staying with them is not the answer to these stocks. I don't know, I answered your question, but idea is profit book regularly for PSU stocks. That's all.
You'd spoken about banking earlier on during this conversation. Give me a view on the banking sector, some of the key stocks. There's a HDFC right up there, but you also have others, and I want you to link it to what's happening on the interest rate front as well. The latest commentary from the RBI. So, what does it mean for the banking sector, especially from a interest rate change likely impact perhaps in 3 to 6 months?
See, we have a different view. I don't think, we in the last credit policy day also was telling that we don't think interest rates can go down in this economy for the simple reason that fact that the inflation rates are significantly higher than what the line that you see in the newspapers. All of us who spend money know for sure that inflation is not 4 to 5%. It's much more out there. Whether it's education, healthcare, we are paying significant amounts of money. So I don't think with this kind of inflation rate and the government new increase in the prices, procurement prices, which government just announced, how does inflation come down in this country? It does not. If you want to give prices of this kind to farmers on the side of agriculture, control the fertilizer and give subsidies, you can't have prices coming down. So, actually speaking, I think it will be very difficult for RBI governor to reduce the prices, even if they reduce the interest rates. Will you go? Will the FD rates go down in the market? Answer is no, because people, will, as you saw, went to capital markets, went to gold, went to every real estate, and money flew out of the banks. So banks can't reduce interest rate in a hurry in this environment. And if banks can't borrow money from FDs at a lower rate, they can't give you a lower rate in the market. I think it's almost impossible in India today for the next 6 to 9 months to 1 year interest rates to fall. I don't think it's going to happen. Even if RBI tries it, it's not going to go through. And I think this governor is very good because he's talking of inflation and again, and the fact that till inflation is under control, I will not move on interest rate. So I don't think interest rate cut, if you ask me, is on the agenda for the next 1 year. And well, banks will have to live with it. And that's a good idea that they become more competitive, they become more cost conscious,
Okay,
and they give us the right services which they have not done so far.
right. In fact, perhaps it's also time, Ajay, speaking on a broader sort of context, for India to look at inflation from a category basket and maybe socio-economic categorization as well. There's a large part of a certain kind of consumer who is being supported by various welfare measures, both by the center and the state governments. Now, that may be driven by political populism and the need to win elections, but there's a impact that, Ajay, you will agree, that's happening actually of that spending or saving. And perhaps just one number at the macro level for consumer inflation may not be the best way to determine interest rate policy, but we have very knowledgeable people in the MPC. We will leave it to them. My last two quick questions for you. I just want to ask you to comment about the high tech space. Uh, it's a it's a very unique time to be in India, Ajay. You have the company, second most valuable company in the world, which invented the GPU, coming to India, talking about investments, and India's largest diversified conglomerate in some ways, RIL, sitting and talking about that. You also have Meta talking about AI's potential in India and doing large language models in 22 Indian official languages. Very soon, in a few days, we will hear from Microsoft, the chief scientist there as well. Uh, from that point of view, do you think the high tech space and the few stocks that are listed in this space is a long term play for investors to consider?
Unfortunately, we don't have too many companies this time. But the fact remains that on the application, the core companies like Meta or Microsoft or let's say you spoke about Nvidia, I think you can't substitute them in India. If you need to invest in AI space, you need to go to the US and we are allowed to invest legally. You have to invest there. India doesn't offer us much chances to invest in companies which can benefit on this. Yes, as and when our IT companies start to roll out and do beneficial application of AI, yes, the benefit will come. But on the flip side, as what we have already seen, that AI is also killing up a lot of the core businesses of these companies. So it's a cutting edge side both sides. Yes, there's an opportunity, but also what it is doing is the core businesses of these companies, updation of code and management of code, writing of code, is all disappearing faster than we imagine it. So I'm not sure India, it's nice to say my conglomerate is doing AI, but they do retail selling of garments. I don't understand how a company who does retail selling of garments and vegetables is now talking of being an AI major. I don't understand. Maybe I'm a lack of wisdom or knowledge, but I sincerely believe that business of AI belongs to the new age entrepreneurs, standalone companies whose need and hour of the day is focused on AI. So I would still say too early for India players to get on board. If you really want to get on board, it's the US companies, lots of them are available to invest in,
Absolutely.
and Indian will not be the right place to invest if you're investing in an AI theme.
Quick point about IT, since you brought that up, and you're absolutely right. The rub-off benefit, if at all, will take time. But how does the IT pack look to you right now?
IT Pact looks to be a wonderful, if you ask me, the wonderful space to be. It's a little more expensive than with comfort to us, given the growth rate that we see in the economy. But in terms of placement of IT companies and some of the mid cap IT companies, I think that's been the standout. Today, our allocation is to the mid cap. We don't have anything in the top line IT companies. But the midline IT companies, some of them have produced, three of them have produced fantastic results and they're doing well. So if you want to
Okay.
invest in IT, which you should, I think the smaller companies will give you bigger bang for the buck than the larger companies. Larger companies are like, let's say TCS. It just gives dividend the whole year round to the Tata Group. It doesn't acquire anything, doesn't do anything. I'm not saying company is bad or good, but that's what it is. It's a dividend machine for the Tata Group. But there's the other three, four smaller companies. They are creating serious value for shareholders. So focus on, I think, mid cap IT is better than the large cap IT, at least in Indian context.
Okay. A dividend machine for the Tata Group. Great line there. Ajay, one final question. Last 2, 3 years saw a pretty strong rally in equities, but times seem to be changing. Growth is slowing down. Companies' earnings are being impacted. There's continuing volatility of several sorts. Since we are doing this conversation in the backdrop of Diwali, look ahead into the new Samvat and tell our viewers, do you think it is going to be increasingly difficult to generate good returns from equities? And what kind of expectations should the average investor have from their equity portfolio?
When markets are down, you tend to feel pessimistic about it, life, okay, and that's what normal people should do. That when the portfolio is down and it's a festive season, you really don't feel good about it. But I still believe equity is good, and there is no doubt we will see a return of 20-25% still coming out of next year equity. But the only key point, and I think that's the most important point, is that you need to stick to your fundamental concept of how and what your whole psyche of investing is. Because if you try to change ships mid ships again and again, you'll not make a return. So you need to figure it out. Are you a high risk or a low risk? And if whichever one bucket you choose, stick by it. I still think equities will make a good return. I still think government will respond to what's happening in the economy at this point of time. They have themselves realized that long-term capex projects don't give enough yield. We need to go short term. Making roads in the middle of Bastar where 5 vehicles travel in a day is nice to put kilometers on the chart, but doesn't give effective economic value. And I think that realization is coming through, and we will see a lot of new initiatives in the government. So let's not lose hope. We were overvalued. We have got now reasonably valued. We may even get undervalued, but that's the beauty of a cycle of equities. We have seen it for 30 years. What goes down goes up, and what goes up comes down. So happy Diwali to everybody on the basis that what's gone down will go up. So keep your chin up.
Absolutely. Happy Diwali to you and everyone. And Ajay, just a closing comment on your last answer. I think that realization that you spoke about may, and I say this very cautiously, may already be factored in as far as the roads ministry is concerned, we seem to be seeing a change slightly in terms of what kind of projects they are choosing. The massive gargantuan multi-year implementation execution project strategy versus quicker, more needed, therefore lesser capital intensive projects. And I think that shift, and once that becomes clearer, the transition will be an important pointer towards how policy, among all other factors, will drive the markets in the new Samvat. Ajay, once again, thank you very much for your time,
Thank you
and
very much.
you, the viewer, for tuning in. Happy Diwali. We'll see you again.